Hi everyone, welcome to this live coverage. As usual, we are here with Yohay Elam and Mauricio Carrillo to cover live the Fed announcement. How are you guys? Are you ready?
Hi guys, yeah, I'm ready. This is Janeth Yellen time. Rock and roll.
Ready? Yeah, I'm looking for action today. Yeah.
We are all looking for action today. I do believe that particularly in the euro, after what we have last week with the ECB, and now all those ranges we have seen until now this week, I do believe we are going to have a nice ride. I hope we have a nice ride.
Yeah, I'm pretty sure that Janeth Yellen doesn't want a draggy moment today.
I don't know. I won't be sure about that. I won't be betting about that.
Okay, so what we can expect for today, Yohay?
No change. That's the easy answer. No rate hike today because things have deteriorated since December. For the first time since December, we have the dot plot. That's the most important immediate impact because we'll know how many rate hikes the Fed now expects. They told us in December that they're going to have 4 rate hikes in 2016. Everybody knew it's not realistic. Now they're probably going to begin climbing down to 2 or 3. And fresh forecasts and the tone of the statement will be watched. I believe they'll be a bit more optimistic about the economy because financial conditions have improved, inflation is higher. On the other hand, wages are a bit stuck, and well, the U.S. growth isn't really impressive, so there's no rush.
You think so?
I want to add, I want to add to what Yohay is saying is that the dot plot has been over-optimistic. I believe that for the past year or so, not only the forecast of rates, but I'm talking about the forecast of growth the Fed has offered alongside with the dot plot for the rates. So I'm not sure how much the market will believe in the dot plot if it said instead of 4, if they say 3 or 2. I do believe that it will have a more negative impact if they say just 1, for example, for this year. In that case, the market will bet that there won't be a rate hike, I don't know, until 2018 or so, and therefore that will be terrible for the greenback. At least that's my view, right?
Okay, I'll take the contrarian view, and I believe that that they will be.
It's always good to have a contrarian.
Yeah. Okay, we'll know pretty sure who's right and who's wrong. As you said, Mauricio, I think Yellen will try not to rock the boat. I think that they will leave the door open for rate hikes, maybe one in June and then after the elections in December. But because inflation is a bit better and stock markets are stable, and there are a few hawks in the Fed, but as we know, the Fed is dovish by definition. So we'll know soon, and then we'll have the press conference, and Dale is missing to do the imitation, but.
And what we can expect from the press conference? You know, any kind of fireworks or, I don't know, any special intervention?
I don't believe so. Honestly, I'm not expecting much from the press conference. I do believe that most of the attention will be in the economic projections and the dot plot. I do believe that will be the trigger for the market. I don't know, unless she decide to make a wild announcement, cut rates back, or something really wild. I don't expect the wording to be that relevant, right? The initial releases will be what will give us a lead.
Yeah, I fully agree. She'll give her regular answers like, well, if things get worse, we'll stand by the economy. If things get better, we'll raise rates. You know, the if-then-else answers, which don't tell us anything.
Yeah, data dependent. So.
Okay, guys. So we have some questions. A question here in the chat. First of all, hello, Ralph, Brack, Diane, Denise, Doc, Todd, Bruce, Lucas, and anyone that is joining in the chat. Jay have a question. I think it's a basic question. Is euro dollar buy or sell? What do you think, Valeria?
Well, Honestly, at this point, I have no answer for that because I have no clue how the market will react in July, right? But overall, what I can see in the market is that the price has been pretty much holding in between two Fibonacci levels, the 23.6% around 1120 and the 38.2 around 10,660, 65 of the post ECB rally, right? So I have a view that if we take this low on a hawkish Fed, we will probably go towards 110, right? And if, on the other hand, we break above 1120, which is also the high of the past 2 days, and we have met some selling interest in there, then the pair can go up to 12 if we have a really dovish Fed, right? But nothing ahead of the release. It's true we have a mild bearish tone in the short term, but who knows? The Fed, the central banks, and the U.S. non-payrolls report are there to play or to how to say this? They distort technical readings, right? They completely distort whatever you are seeing in the. They have the ability to do it. They not always do, but central banks can do that, right? So it's a wait and see. It's also relevant is that the pair has managed to regain the 200 simple moving average, the brown one, in the post-ECB rally. It has been trying to try back. So overall, it seems like there's a mild bullish tone in the long ride, but who knows? Let's see what happens today and where we close the week. If we close the week below 110, I don't see much chances of the upside, honestly.
And also pay attention that we have interest rate decision tomorrow by the Swiss National Bank and the Bank of England.
Yeah, I do fear more the Switzerland National Bank than the Bank of England, you know, because after the ECB decided to launch negative rates, the Switzerland National Bank, sorry, has to do something. It has to do something, right? To imbalance, to balance that I don't know how to say it, but it's affecting the Swissy, of course. If the euro gets stronger, the Swissy does also, and they have been struggling for years now for a weaker Swissy. So I do expect them to do something, probably cut rates further, or I don't know, announce some sort of easing. Who knows? Facilities.
Yeah, will you be covering that, right, Yohay? Because it's in the
it's during the show. I don't expect them to change rates, but they will keep the strong line. They will defend the economy and fight against inflation and intervene when necessary. I think it seemed like they intervened during the ECB, the 1 hour that the euro dollar was falling after the ECB announced all this huge stimulus package. Then it seemed that they were intervening, and I think they'll continue doing that. For now, with euro dollar a bit higher than after, I mean, with this backfire of Draghi, I don't think there's a need for them to intervene. I mean, to change rates, but you never know. Wait for the event. Don't trade before it.
Yeah, that's right. That's right. So, what's going on in the Japanese yen, Val? I know this is your favorite pair. It's testing some highs, right? Valeria.
Yeah, I'm here. Sorry about the dollar Japanese yen. Well, you know, I have been following the pair, and I will start with the weekly chart, right? Take a look at the weekly chart. We have been 3 weeks in a row pretty much stuck around this 1350, 1360 area, 3 doshes so far. The fact is that the Bank of Japan had left its policy unchanged on Thursday, right? And overall, the market was thinking on buying the pair, but yesterday, sorry, in this previous Asian session, Governor Carrillo, speaking before the Parliament, said that they have room to cut rates further, right? That's why the pair gained some ground today. I do believe he mentioned that they can cut rates down to minus 0.5%, right? So here we are. back toward above 13. Anyway, as I said plenty of times, I do believe over these past 3 weeks, I don't like it. I don't like buying here unless we take 1505, which is a 38.2% retracement of the post Bank of Japan meeting decline of the past month, right? This is a late January, late January meeting, right? So at this point, it's pretty much neutral for me. Of course, it tends to react strongly with the Fed. So whatever happens today, I do believe that it will be a nice riding year. Oh, what a day I'm having. Sorry, guys.
Yeah, it was a bit confusing. In the rate decision, they decided not to change policy, and they even removed the section that was talking about changing policy, reducing further the negative rate. But as you mentioned, the following day just went to Parliament and said, yeah, we can reduce rates. So we're back to the same place. 114.55 is the level I'm watching. 116, which was the previous line in the sand. And then the downside, 112.20 and 111, the double bottom. The dollar yen will be. Let's see how dollar yen reacts to the Fed in just 2 minutes, right?
Yes.
Yeah, almost.
Yeah, it's quite a busy day in markets in general. We had the UK budget release, which showed lower growth forecasts. We have Australian employment data later tonight and New Zealand GDP. A bit for everybody today. Crude oil inventories for those trading the Canadian dollar.
Fell, right?
Yeah, very busy day.
It's a busy week, but the market did not notice ahead of the Fed. Hopefully they will notice everything now.
Yeah, okay, less than 1 minute.
Yeah, Mayer's starting to get nervous. Game time. Remember, guys, we have a little delay. You will see us commenting the results some 30 seconds later or so.
Yeah, for decision imminent.
Yeah. Let's put euro dollar here on my chart. 110.84 before the release.
Yeah, the OC is pretty nervous.
Yeah, it climbed down from the rally.
The stocks are going down.
And
badly to run against the greenback. Yeah, there we go. Okay.
No change in rates. No change in rates.
Not change. Not change.
Okay, small gaps. Ignore.
Dollar is falling. Dollar is down.
Okay, breaking through my resistance.
Wow, quite a climb. Wow. Guess you were right, Val. Looks like the dot plot was, according to the dollar reaction, was not that favorable.
Yeah. I'm trying to get a look at it.
Yeah, quite a collapse. Yeah, I'm also looking for that. Let's see what the statement reads. For immediate release. Economic activity has been expanding at a moderate pace. Despite the global economic and financial developments of recent months, household spending has been increasing at a moderate rate. The housing sector has improved further. However, business, fixed investments, and net exports have been soft. A range of recent indicators, including strong job gains, points to additional strengthening of the labor market. Inflation picked up in recent months. However, it continued to run below the committee's 2% longer-run objective.
Yeah. Fed signals to rate hike. Sorry for interrupting you.
Yeah, no, that's more important, right? Yeah.
2016 instead of 4. That was it. The dot plot. Yeah. Sorry. Go on.
Oh, that was the key figure I was also looking for.
Yeah, well, I got it. I got it first.
Yeah.
Yeah, seems they they downgraded their probable rate hikes, and maybe June and December, as you said, maybe September and December, which seems less likely, right? Two in a row. I don't know, but if they also cut their GDP forecast, right, to 2.2 versus prior 2.4 for this year.
Yeah, they're always too optimistic.
Yeah, and given that, that's why the dollar is plummeting.
Yeah, but the Fed says 2 rate hikes, not 4. It was 4 before. Yeah, lower. Yeah, go ahead, Valeria, sorry.
No, it's okay. I'm just saying how the euro is breaking also through the 1.1160 resistance with not caring much about. In fact, everything is moving through some intraday support resistance levels, and without aims to look back, I do believe that we will see a fighting here in the euro, a little battle, short-term one, and if we manage to take it higher, then we will probably reach that 112. In the pound, I was watching daily basis this rally, which is this year's slide, right? And last week, with a strong recovery, we reached missed, in fact, by a couple of pips, the 61.8% retracement of that rally. So it was a major resistance level. Then the pair plummeted, and now we are about to take back the price above 38.2. I believe that if we do, then there's room for further gains in the pound. But at the moment, pound is being weighed by fears of Brexit, right? So maybe not the most reliable one to buy at this time. Yet, if the price manages to break that resistance after a few minutes, then it will probably extend its rally. And there's go the euro retreat. There was a small gap in the euro and in the Swiss, at least in my charts. Nothing really relevant, and sometimes it's because of the violence of the movement, but that's what I'm seeing right now.
Yeah, there was one dissenter. Esther George voted for a rate hike, so it was a hawkish dissent. That also shows the decision was dovish, and and the dollar is really falling across the board, all over. Yeah.
The dollar-Japanese yen is holding above 13, which is quite notable given the dollar weakness we are seeing. But to be honest, if we close the day somewhere below 13, I would expect the bearish trend to resume and a retest of the 111 lows we see late February, right?
Reading through the statement. Let's see if we can get more data.
Sorry, we have a question here from the chat. Where we have, Mojo is asking, do you expect that the dollar will come back stronger in the next hours after the press conference?
Not really. Depends on what Yellen has to offer, but honestly, it doesn't look like mayors are breaking through their recent highs in the short term, and that probably signals they still want to go against the greenback.
They are watching for some Draghi movement, Draghi moment from, lower euro and then strong back.
Well, that's not something that happens every day.
Yeah, it's kind of guess.
Yeah. It's dramatic Draghi. It's not dramatic Yellen.
Yellen is not so dramatic like Draghi.
Yeah.
I think most dramatic is the current music that the Federal Reserve is playing in his website. Amazing.
So we had a small edge for, according to bond markets, rate hike expectations showed a bit more than 50% for rate hike in June. Now it's a bit more than 50% for no hike in June. So there's a small shift in expectations to the dovish side.
Yeah.
Well, that means the euro dollar could go as high as 115 in 1 or 2 months.
Wow. That seems way too much for me. I have to be honest.
But if the market has been pricing like a 4 hikes,
yeah.
Now, you know.
Take a look at this weekly chart, the 1460 region, right? We have tried many times, and I'm talking about January 2015, over a year now, that the pair has been unable to rally beyond that level. We have that wild spike in that Black Monday from China in August, I believe it was, right? Yeah, but it was short-lived, right? So that's the major bullish target, right? In here, and that if we take out 1215, the first wall we have in the way towards that 1460.
Yeah.
So I do believe it's a bit too early to talk about.
Right?
What?
Like a flag formation.
Yeah. Anyway, it's a bit too early to talk about 115. Besides, I don't believe Draghi will let it go that high or will be happy. Of course, he has waste all his nuts. What else can he do now?
Yeah, I think markets were positioned for a slightly more hawkish Fed, especially after the inflation report today. I also thought they would be a bit more hawkish. So we're seeing it move down in the dollar, but yeah, 115 is a bit too far out.
Yeah, but everybody's talking about the euro dollar, but watch the Canadian dollar.
Yeah, it's a new low for the
Australian. Yeah.
Yossi is recovering in 1 hour what it lost in over a day. Yeah, well, Yossi has been pretty bullish lately, to be honest. We have that today decline. If you take a look in the daily, it's just corrective. And all of a sudden,
Yeah, it looks like an uptrend.
Yeah. Gold is also welcoming the Fed non-rate cut.
Yeah, the gold and the stocks are recovering losses.
Yeah.
Yeah. Okay, what we need to focus in the Janeth Yellen speech. Yohay.
Yeah.
About the general view of the economy, if regarding rate hikes, we're never going to get a straight answer. So we're going to have to understand what they feel about the economy. If they see it more as moving forwards, inflation is rising, these kind of positive things, it could sort of stop the dollar's fall. But if they focus on the words, they use the word soft in the opening paragraph of the statement regarding net exports and fixed investment, then I think we could see, that could weigh on the dollar. Anyway, basically their view of the economy.
Okay.
The S&P just touched 2025 after the release. It's trading higher. Yeah, it's at 2016 highs. Yeah. Let me check, Valeria.
Okay, thanks.
Canadian dollar. Yeah, it's risk on once again. Good news for commodities.
What about China? What will China do?
Valeria and Yohay here we have a question. We got a question from, let me see the name. Carlos is asking about the New Zealand dollar. What do you guys expect from the New Zealand dollar?
Well, in the short term, of course, it will follow the rest because the market is now about selling the greenback and nothing else. It's not about whatever happens in New Zealand or in Australia and anywhere else. I do believe that the pair has been really bearish long term, and now it's trying to recover some growth, but with the Reserve Bank of New Zealand still in the easing path, there's not an easy way towards the upside in here, you know. It seems a bit messy right now because we have this lack of direction, okay, but I do believe that 67.10 is the level to beat right now to see further gains. I'm reluctant, however, to buy the New Zealand because with all the strong rally we have in the Aussie, the pair was unable to follow through, you know, over the past couple of weeks, I mean. So beware of that. Beware because I do believe that the risk remains towards downside in there.
Yeah, I agree. I also see downside. Sorry.
No, sorry. I was asking if you can hear me.
Yeah. I'll also add that, yeah, also, milk prices fell yesterday. We had this report coming out of New Zealand, another sort of another thing weighing on the kiwi. And later today, in just I think 2 hours from now, 2.5 hours, we have New Zealand releasing its GDP. Slower growth is expected, 0.6 quarter over quarter instead of 0.9, and 2% instead of 2.3. So that will be sort of, at the moment, yeah, it's rising, but it's lagging behind, as Valeria said, the Aussie, the CAD, other currencies. So if we have a small miss on GDP or just as expected, which is lower than last quarter, I think it could remain depressed.
You extended up to what, 1186?
Yeah, the high 1186.
Okay, I don't know, but my computer is trying to install something. Can you hear me?
It's trying to install a robot to trade.
Oh my god. I don't know what's this. Oh, now my charts are all. Oh god. Oh, I can't do anything. Oh. Okay, sorry guys.
No problem. So we have more questions here. Yohay, what is your take on the euro pound?
Well, here we are, 78.60 above 78.50, which I marked as resistance in the past. Now it's a bit choppy. 79.30 is the next line of resistance. Support 77.40, which is a very old line. 80 is, of course, the higher level up there. I'm bullish on this pair and this cross because of the weakness in the UK, the slash of growth forecasts, the fears of a Brexit, which will continue staying with us for another 3 months. Euro-dollar is more stable. It's more because of the weakness of the pound that I see room for the upside on this cross.
And especially, well, do you expect anything tomorrow from the Bank of England?
Dovishness. Everybody's dovish. It will not be such a big surprise though, because you know that's the trend now. Everybody's dovish.
Oh my goodness, we are living in the dovish world.
Yeah.
Everybody wants to go south, and it's not Florida, you know.
No.
And not in Argentina. Have you heard about Lula da Silva today? That was appointed like from the cabinet to avoid some prosecution.
Yeah, very dirty politics.
Yeah. Well, what a corruption.
Yeah, well,
the
welcome to South America.
The Brazilian real fell like a 3% of the news, and then
Wow.
right now it's recovering some ground, but it was amazing. Okay, let's see what's going on more here. So Smita, I know this is a question for you, Valeria. Smita is asking which currency is coming out the stronger of the patio.
Give me a second.
In your opinion,
I
where is
lost.
the? Oh, I see. Yeah, you lost your charts. So, in your opinion, what is the strongest currency right now? I don't see
The
the dollar.
strongest remains, you know. I do believe that
Sorry,
the stronger. I
Yeah.
do believe that the stronger is still the Aussie. You know, it's the
Yeah.
one with more self-strength than any other. So I trust it. But anyway, I will try to get back my charts. Give me a second. Sorry, really sorry. I'm having a bad day with the computer. I'm not sure why nothing.
Yeah, I agree with what Valeria said. The Australian dollar still has a lot of strength behind it. Aussie is less worried about China. GDP is up. It also faces a big test tonight with the Australian jobs report. As long as it's okay, I see more room for the upside. It completing its correction, getting new fuel for the rally from a dovish Fed. And yes, well, assuming it won't be a disaster, the Australian jobs report tonight. No.
Okay, guys, I will try to restart my computer. I will be back in a minute. Okay.
Yeah, no problem. We'll be back. We will be here, just waiting for Janeth Yellen's speech. No problem.
Okay.
So, guys, we are waiting for Janeth Yellen. She will start her press conference at 2:30 p.m. Eastern Time. This is in 12 minutes. We are coming from unchanged decision from the interest rate of the Fed. Carlos asked us, or he said that, so you think that we should sell New Zealand dollar now before it heads back down? And Carlos, we don't provide signals, so you should do your own work and take your decision after, anything that we are talking here. If you have any idea of trading, you can share your idea here in the chat and share some screen if you have some charts, and we will be more than happy to comment that. Okay. So, in your opinion, Yohay, the strongest pair is the Australian dollar right now.
Yeah, good reasons to like the Australian dollar. Strong GDP, less dependent on China. China also supports more growth. They sort of committed to supporting strong growth for the next few years. And also, well, again, watch out for the Australian jobs report at 5:30 midnight GMT. A small gain in jobs is expected, and the unemployment rate is expected to remain at 6%. As long as this jobs report is not a total disaster, then we can see the Australian dollar continuing to the upside. Also, the Canadian dollar, I see some strength over there. Yes, it rallied a lot against the US dollar since the Bank of Canada decided not to cut rates. But there's also justification for that with the stronger oil price, and the Bank of Canada was relatively neutral. Many expected it to go dovish. Anyway, we're seeing oil prices, WTI crude oil here at $38, rising, enjoying the Fed decision. Of course, less rate hikes, more easy money is good for oil prices. We also heard today regarding oil prices, and this impacts, of course, the Canadian dollar, that OPEC and non-OPEC members will meet on April 17th to discuss some kind of cuts. I don't expect these countries to reach any kind of decision, especially if oil prices are not very, very, very low. So, but until then, we have some hope of some coordinated action to cut production, and this supports the Canadian dollar. So, it'll be supported by oil prices, I believe, in the next month or so.
And where is the weakest?
The weakest is still the pound. The pound, well, making an amazing correction right now. Yeah, but I think the fears of Brexit, recent purchasing managers indices in the UK, lower growth forecasts by independent analysts, by the government, by the Bank of England. We'll probably hear that tomorrow. Even though the economy isn't doing that bad, but the trend looks to the downside, and I see the pound is still in the next 3 months still pressured by the referendum. That's my opinion.
Okay, thank you. So we are 8 minutes to go with Janeth Yellen. Again, what we need to focus in this press conference.
She will be asked, of course, about the path of rate hikes, what this means. She'll answer, well, if things get better, we'll hike rates. If not, we won't. No easy answers on that front, no direct answers. She will be asked on the U.S. economy, and I think that could make a difference if she focuses on some better figures like durable goods orders, inflation, job growth. But there are also so many negative things like wages, retail sales, which were finally, we thought that they were getting better, and these downwards revisions just killed the hope. So the U.S. economy remains mediocre. So it'll be hard to, she'll probably try to not to rock the boat, to paint a balanced picture, but eventually analysts, and of course, we'll see how things evolve. I think she'll be a bit more optimistic, but yeah, I was wrong on the hawkish expectations from the Fed, and the dollar is falling, so I won't take a bet. Yeah, I would also note that we often have secondary and further reactions to the Fed, not only at the press conference, but also at the Tokyo Open, also in the Europe Open, and also when we have some journalists like John Hilsenrath of the Wall Street Journal, when he'll release his analysis of the Fed, will have another impact on markets. Of course, there are also other journalists worth watching because the Fed is so complicated. These Fed watchers, these analysts, have an impact as well.
I see. And moving on to the Swiss National Bank and Bank of England, what are your expectations to that central banks that we have tomorrow?
Well, if the situation remains like this on euro dollar with a stronger euro, then this Swiss National Bank can be a bit less dovish. I don't expect them to make any changes to policy in any case. I do expect them to continue with the tough language, that they will continue fighting deflation, intervene in forex markets when necessary, do everything it takes more or less, and watching the ECB, of course, but not changing policy per se. But as Valeria said before, there is, of course, a chance they will further cut rates just to keep competing with the ECB's rate cut, and that will, of course, be very negative for the Swiss franc, especially against the euro. That's the pair they are specifically watching. Regarding the Bank of England, I expect them to be dovish. No rate hike, no rate cut. But as we know, we have the meeting minutes. Again, 9 will probably vote against any change, and 0 for a rate hike. Same like last month. No dissenter, no Ian McCafferty voting for a rate hike. And the commentary will probably be dovish, watching the global economy, watching inflation, and things like that. And also, they will not say anything about the referendum, even though we know that they prefer the UK to stay in the EU, nothing to rock the boat. But they will express fears probably in some way about uncertainty. The word uncertainty will probably be prevalent in the meeting minutes.
Okay, so they will be so dovish and that they will not have tea time.
No, tea time is later on, but yeah.
Yeah. So there is a question here. William from the chat is asking about the dollar, Canadian dollar. If you have any take on that.
Well, I like the Canadian dollar. It did rally a lot, as I mentioned, but I think there's still room. It did make some kind of a correction. 130, 170 is support because it was the line we've seen last week. Of course, the line below this is 130, and under that we have 128, which was a low. On the top side, 134.60, which was a double top in September and December, remains resistance. My bias is dollar CAD negative. That means positive on the Canadian dollar because of stable oil prices, because the Bank of Canada is not in any rush to go dovish. I mean, everybody's dovish, yeah, but they're not the most dovish. So that's my tendency. I see a continuation of this trend, dollar CAD to the downside, rather than a turnaround.
Yeah, and what are the levels to watch in the downside? You know, there is a. Do you think that the pair will go as low as 130 or even 179?
We'll need some. I think the Fed's dovishness might not be enough to go all the way to 130. Hey, Valeria, you're back.
Yeah.
130, 170 is the next level. And we should watch out for 128.30, which was a low in October. Yeah.
Oops. Okay. So Valeria, you are back.
A program, in Chinese or something like that has been installed in my computer. It's open ads and Facebook. I don't know what. And okay, but anyway, let's see if I can do something, guys. I really apologize. I don't know.
Have you seen? Are you amazed with the euro dollar?
What happened? I leave a couple of minutes, and there we are. The market keeps rallying, right? There we are at 12. Yeah, the market is breaking through the levels we mentioned. 12.15 region lows in the dollar Japanese yen are the next to take.
Yeah. The S&P is at highs. Crude oil is up. The gold is. What is your take in gold?
I have been talking about the possibility of a bullish rally ever since the year started. As I always had commented, the fact is that oil has been highly correlated with the Fed, right? It has been plummeting all through the last year in advance to the possibility of a Fed rate hike. And once the Fed said what they were going to do and how and what, it stabilized, right? And all of a sudden, the things gone south in the US and the gold began to rally. Now that the Fed has downgraded its outlook and changed their upcoming events, there we are. The gold will likely recover ground. I do believe that we will see 1300 soon, to be honest.
So we are moments away. Valeria, I have echo from you.
Could be. Sorry, it's the air conditioner. I have just turned it off.
Okay. No, my voice is coming from your side, I think. Okay.
Okay. Can you hear me?
I can hear me from your side. Okay, now it's fine. And here comes the lady.
Yeah.
Yeah. Let's see what he has to say.
Good afternoon.
Can you see?
Today, the Federal Open Market Committee decided to maintain the target
I see the charts, but not sure.
rate at 1/4 to 1/2%. Our decision to keep this accommodative policy stance reflects both our assessment of the economic outlook and the risks associated with that outlook. The committee's baseline expectations for economic activity, the labor market, and inflation have not changed much since December. We With appropriate monetary policy, we continue to expect moderate economic growth, further labor market improvement, and a return of inflation towards 2% in 3 years. However, global economic and financial developments continue to pose risks. Against this backdrop, the committee judged it prudent to maintain the current policy stance in today's meeting. I will come back to our policy decision momentarily, but first let me review recent economic developments in the outlook. The labor market continues to strengthen. Over the most recent 3 months, job gains averaged nearly 230,000 per month, similar to the pace experienced over the past year. The unemployment rate was 4.9% in the first 2 months of the year, about in line with the median of FOMC participants' estimates of its longer-run normal level. A broader measure of unemployment includes individuals who want and are available to work, but have not actively searched recently, and people who are working part-time and would rather work full-time, has continued to improve. Of note, the labor force participation rate has turned up noticeably since the fall. More people working or actively looking for work as prospects for finding jobs have improved. But there's still room for improvement. Voluntary part-time employment remains somewhat elevated, and wage growth is yet to show a sustained pickup. Improvement in employment conditions so far this year has occurred as economic growth appears to have picked up from the modest pace seen in the fourth quarter of last year. Household spending is expanding at a moderate rate, supported by job gains and increases in inflation-adjusted incomes. In contrast, business investments are reflecting further reductions in oil drilling as a result of low oil prices. Net exports also remain soft as a consequence of subdued foreign growth and the earlier appreciation of the dollar. Looking ahead, the committee expects that with gradual adjustments in the stance of monetary policy, economic activity will continue to expand at a moderate pace, and labor market indicators will continue to strengthen. Ongoing economic growth and additional strengthening in labor market conditions are important factors underpinning the inflation outlook. Overall consumer price inflation, as measured by the price index for personal consumption expenditures, stepped up to 1.25% over 12 months ending in January, as the sharp decline in energy prices around the end of 2014 dropped out of the year-over-year figures. Core inflation, which excludes energy and food prices, has also picked up, although it remains to be seen if this firming will be sustained. In particular, the earlier declines in energy prices and appreciation of the dollar could well continue to weigh on overall consumer prices. But once these transitory influences fade, as the labor market strengthens further, the committee expects inflation to rise to 2% over the next 2 to 3 years. The committee's inflation outlook rests importantly on its judgment that longer-run inflation expectations remain reasonably well anchored. However, the stability of longer-run inflation expectations cannot be taken for granted. Survey-based measures of longer-run inflation expectations have changed on balance in recent months, although some remain near historical low levels. Market-based measures of inflation compensation also remain low. These indicators reflect many factors, and therefore not providing accurate on changes. Inflation expectations are most relevant to wage and price setting. Nonetheless, our statement continues to emphasize carefully monitor actual and expected progress toward our inflation goal. This general assessment of the outlook is reflected in usual economic projections submitted to this meeting by FOMC participants. As always, each participant's projections are conditioned on his or her own view of appropriate monetary policy, which in turn depends on each person's assessment of the multitude of factors that shape the outlook. Participants' projections for growth of inflation-adjusted gross domestic product are just a touch lower than the projections made in conjunction with the December FOMC meeting. Median growth projection inches down from 2.2% this year to 2% in 2018, in line with the estimated longer run rate. Median projection for the unemployment rate falls from 4.7 at the end of this year to 4.5% at the end of 2018, somewhat below the median assessment of the longer run normal unemployment rate. The median path of the unemployment rate is a little lower than in December, in part reflecting a slightly lower median estimate of the longer run normal unemployment rate. Finally, with transitory factors holding down inflation expected to abate and labor market conditions anticipated to strengthen further, the median inflation projection rises from 1.2% this year to 1.9% next year and 2% in 2018. The median inflation projection for this year is a little lower than in December, but thereafter the median projections are unchanged. Since the turn of the year, concerns about global economic prospects have led to increased financial market volatility and somewhat tighter financial conditions in the United States, although financial conditions have improved notably more recently. In addition, economic growth abroad appears to be running at a somewhat softer pace than previously expected. These unanticipated developments, however, have not resulted in material changes to the committee's baseline outlook. One reason for this is that market expectations for the path of policy interest rates have moved down, and the accompanying decline in longer-term interest rates should cushion adverse effects on domestic economic activity. Indeed, while stock prices have fallen slightly since the December meeting, and spreads of investment-grade corporate bond yields over those on comparable maturity Treasury securities have risen, mortgage rates and corporate borrowing costs have moved lower. Of course, the committee will continue to monitor these developments closely and will adjust the stance of monetary policy as needed to foster our goals of maximum employment and 2% inflation. Turning to monetary policy, as I noted earlier, the committee decided to maintain its target range for the federal funds rate. This decision partly reflects the implications for the U.S. economy of the global economic and financial developments I just mentioned. In addition, proceeding cautiously in removing policy accommodation at this time will allow us to verify that the labor market is continuing to strengthen despite the risks from abroad. Such caution is appropriate given that short-term interest rates are still near zero, which means that monetary policy has greater scope to respond to upside and to downside changes in the outlook. As we indicated in our statement, the committee expects that economic conditions will evolve in a manner that will warrant only gradual increases in the federal funds rate. The federal funds rate is likely to remain for some time below levels that are expected to prevail in the longer run. This expectation is consistent with the neutral nominal federal funds rate, defined as the value of the federal funds rate that would be neither expansionary nor contractionary if economy was operating near potential, is currently low by historical standards, and is likely to rise only gradually over time. The low level of the neutral federal funds rate may be partially attributable to a range of persistent economic headwinds that weigh on aggregate demand, including developments abroad, a subdued pace of household formation, and meager productivity growth. There is considerable uncertainty regarding the evolution of the neutral funds rate over time. However, if these headwinds abate as we expect, the neutral federal funds rate should gradually move higher as well. This view is implicitly reflected in participants' projections of appropriate monetary policy. The median projection for the federal funds rate rises only gradually to 0.9% late this year and 1.9% next year. As the factors restraining economic growth are projected to fade further over time, the median rate rises to 3% by the end of 2018, close to its longer-run normal level. Compared with the projections made in December, the median path is about 0.5 percentage point lower this year and next. The median longer-run normal federal funds rate has been revised down as well. In other words, most committee participants now expect that achieving economic outcomes similar to those anticipated in December will likely require a somewhat lower path for policy interest rates than foreseen at that time. I would like to underscore, however, that the participants' projections for the federal funds rate, including the median path, are not a plan for future policy. Policy is not on a preset course. These forecasts represent participants' individual assessments of what appropriate policy would be given each person's own current projections of the most likely outcomes for economic growth, employment, inflation, and other factors. However, considerable uncertainty attaches to each participant's forecast of economic outcomes. Hence, their assessments of appropriate policy are also uncertain and will change in response to adjustments to the economic outlook and associated risks, as was the case between December and now. Also, it's important to note that the committee makes its decisions on a meeting-by-meeting basis and does not and need not decide on a likely future path for the federal funds rate. Indeed, the future path of policy is necessarily uncertain because the economy will surely evolve in unexpected ways. As we note in our statement, the actual path of the federal funds rate will depend on the economic outlook as informed by incoming data. Finally, the committee will continue its policy of reinvesting proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As highlighted in our policy statement, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and should reduce the risk that we might have to lower the federal funds rate to zero in the event of a future large adverse shock. Thank you, and I'll be happy to take questions.
Okay.
Well, I don't hear much of what she said, but I see you were at 112, so I'm pretty sure we don't like it.
She made clear that yes, the path for raising rates is now lower, and a specific worry about developments abroad. Global growth looks lower.
Like China and so, how they are affecting. Anyway, the euro is about to take the high posted after the ECB, and if we do, guys, I do believe we are going to test that 1240-50 region we were talking about with Yohay ahead of the meeting. I believe that's a major bullish target should the pair break higher. Also keep in mind that the rally has over 150 pips already, so maybe we're not going to see another 100 pips higher. It seems unlikely, but not impossible. And keep in mind that in about an hour, the U.S. market closes, right? So trading platforms also cool down, and we're seeing some little action across the forex world. Are you there, guys?
Yeah, sorry.
So far we stopped exactly there.
You're shocked with Yellen? Come on.
No.
No, okay.
Yeah, the market is now pricing in a rate hike for September, I believe, rather than June.
Yeah, it's now 55% against the hike in June. Yeah.
Yeah, so we have seen the greenback under pressure for the past couple of weeks or even longer. So I do believe that this will support that trend, right?
But the mode is bullish for the euro dollar. The mood.
The mood. Yeah, the mood is dollar bearish.
Yeah.
Yeah.
Yeah, she did mention the US dollar as a source of lower inflation, even though things have turned around a bit. But, well. $112.15 holds for now.
And Yellen is repeating that the future part of the policy is data dependent.
Yeah, well,
as always, you know.
Yeah.
So let's look at the Japanese yen. Sorry?
Yeah, I was just thinking about the dollar Japanese yen, and stocks are generally higher, right? You take a look at the Dow. The US stocks are higher. Not sure Nikkei futures are stuck, but anyway. So maybe the downside will remain limited in the dollar Japanese yen, right? The immediate support now is 12.10, where we have bought a couple of times during these past days. And below that, I believe there's room for a retest of the 11 region, as we said earlier.
There is did you say, well, there is a question in the chat. Did you say 112.50 euro dollar? 112.10. Okay.
Yeah.
No, this is the Japanese yen.
Immediate support, a short-term one, and we reach it with the speech. Take a look at the 4-hour charts. We have a more relevant one, 12.10. That's the next one. And if we take it, then it's a good rise down to 11, I do believe.
Yeah.
Go ahead, Yohay.
Yeah, we slipped a bit lower. When I see 112.20, 112.10, what Valeria said, and then of course the big line, the double bottom there of 111.
Yeah.
And Tat is asking you, Valeria, if you say 112.50 in euro dollar before.
12.50. Yeah, sorry. Yeah, if we take, I would say that if we take the post rally high, we still 2 pips below it now. But next resistance, if we take 17.20, is the 12.50 region. 12.45.50. It's major resistance level. So I do believe that the pair can go up to there. And
yeah, it's not that far away.
Yeah.
Here we are, breakout.
Yeah, it's at fresh highs, so bye-bye Fibonacci retracement.
I think we will visit the 113.50 in the next 2 weeks.
Let's see if the ECB is right there.
I'm amazed with commodity currencies. Those are the ones leading the way higher. They are welcoming not only the comeback in oil and gold, but also the strong momentum in US stocks
Yeah, oil is on a roll.
Yeah.
38.55 in WTI. The high there was 39, and of course the round number of 40 is above.
Yes. Also getting support from early reports showing decrease in stocks in the US, right? I do believe that the oversupply market will remain. So not that I'm saying that oil can go up to 50. Honestly, I'm not seeing it. But of course, with the broad weakness in the greenback, we can see it breaking 40 in the coming sessions.
Let's check what the forecast pool say last Friday. I know, I like your picture of Donald Trump, Valeria, in your Twitter feed.
Where?
So, let's see the forecast, the currency forecast pool that we published on last Friday. It was 75% of the forecasters were bullish with a target of 1.1210. So we already there, right?
Yeah, here we are.
Yeah.
112.25.
Yeah, and then for a month you want 10 back, and then bearish in the quarter. But this is interesting that we were bullish to 112.10, and then we got it.
If you take a look at the forecast, what I like about this new forecast is that if you take it in the weekly, it's at 75% of the market is bullish. In
Yes.
1 month, it's 25% just bullish and 77% bearish. And for quarter, it's just 19% bullish. So that's telling me how the market feels about the future of the euro right now. 25, and then 19. I mean, the market is not really expecting a 15, as you were saying earlier, or maybe it is, but not really convinced about it. Maybe we reach that level and they will take their chances to sell. But honestly, if you take a look at how the euro area economy is doing, it's not that the euro can go to 120, right? It's not that there's supportive. The data is not supportive of a stronger euro these days, at least.
Yeah, that's right. That's
there
right.
we go. The dollar Japanese yen breaking through 12.15.
Australian dollar is extending high. Sorry.
Yeah, one of the stronger currencies out there.
What?
So the Canadian, the Aussie, and also the Canadian dollar.
Yeah,
Quite
in an hour.
impressive.
It's not an hour yet, and it has erased 2 days of losses. That's telling you where the market is, or where the market wants to go.
Yeah, and dollar CAD is the lowest since November.
Okay.
Quite a move there.
What is that? The McKinley mountain.
Yeah, it's in Alaska.
Okay, this just broke below 132. Yeah.
Gold.
Like you said before. Okay.
Take a look at gold. Oh.
Look at that. So what we can expect from gold, Valeria?
For gold?
This is testing height right now. It's testing 1260. I think.
I don't like to jump into this party right now, but I would like to wait either for a pullback or some consolidation in the market. But honestly, this is bullish for me. I'm quite bullish. Not only for today, but I mean for the coming days, because that 2 rate hike announced or anticipated by the Fed has underpinned bulls, They take profits out of the table ahead of this release because they were with the idea of a 4 rate hike this year. Now that they confirm half of that, they're up. They can keep on buying until June, That's what I'm thinking.
coming back to Canadian, this is Siri just share with us. Let me know where it is. It's here. Siri just share with us a chart that just the downside target has been hit, and I guess he's expecting a recovery until 133 now in the bearish channel. If you can see the chart that I'm showing right now.
Let me see.
Valeria and Yohay.
Okay.
Yeah.
I see the calendar. I can. Okay, now I can. Oh my! Do you need a line, Mauricio?
Well, the downside target has been
smaller.
Yeah, well, check out some of those lines. I can't see the price.
The price reached is 131.20.
Yeah, I know. I'm kidding. I mean, you have too much things going on in there.
Yeah, and she is expecting that the pair will go back to 133 and higher.
Yeah, to the upper side of sort of a descendant channel the pair has.
Yes.
Yeah, maybe you can guess it there in between all those lines.
Yeah.
Yeah,
okay.
That
so
green line? Sorry, go ahead.
No, go ahead, Valeria. If you
I was saying that if we take out that green line you have in there, there is a good chance the pair will keep on falling down to 130, right?
Yeah. Okay. So, guys, we are just almost ready to finish. So, I would like to ask you about a recap of what happened today and what will happen in the next few hours, and if you have any forecast for the next two central banks, the Swiss National Bank and the BOE. Valeria, ladies first.
Yeah, I know you were going to say that. Well, first of all, I want to apologize for falling down so many times and having some computer issues, but well, you know how these things work. Secondly, well, the Fed was huge dovish, largely beyond market expectations. The dot plot, as we discussed at the beginning of this live coverage, was the key because they downgraded their growth forecast, not to mention that they decide now that they will raise rates only 2 times out of 4 that they pledged on in December, right? And also, as we commented earlier with Yohay, the Fed has been over optimistic with this forecast, right? And the market know it. So that 2 may mean just 1 in this year or maybe none, and that's what the market has run to price in. The market is currently pulling back a bit. As I said, the euro rally 150 pips, and the Aussie, I don't know, but even more than that, and so on. And of course, the market will try to settle right now, correct a bit, consolidate. As the US session is about to close, 1 hour left. So for the most, I'm not expecting much until the next Nikkei opening, right? When Japan comes in, that will be the next ride, and they will probably keep on sending the greenback. Okay, so long term, this is quite negative for the greenback, and so it is short term. And finally, when you ask about central banks, I agree with Yohay that the Bank of England is expected to do nothing. The super tertiaries have become super boring because. Yeah, honestly, because we have meetings, statements, minutes, decisions, but as long as they remain flat, the pound is not going to react to it. Of course, I do believe that one day.
Have Draghi.
Yeah, one day they will surprise us, you know, but it's not going to happen tomorrow, and I don't believe it was going to happen in this first half of 2016. Not a chance. Maybe the second half of 2016 we have some news in there, but so far nothing. So the Bank of England, probably a non-event. The market may decide to give up on some of Brexit fears too soon. I do see some downward potential if we lost back the 42.20 level, which is a major Fibonacci support. And for the Bank of Switzerland, I'm not pretty sure, but I won't expect them to remain on hold. You know, I do expect them to do something. They don't want a stronger Swissy, and what's going on is a stronger Swissy, and they don't want that. Maybe a hard talking and intervention, as you had said, maybe a rate cut further, I don't know. But my take is that they're going to act. And that's it.
Valeria, Tesla start from the chat, say that he sees 114.60 for the euro dollar. Do you see that?
Yes, it's likely, as I said, it's a major level. Take a look at the charts. It's around there, okay? The price has been rejected from that resistance area plenty of time since early 2015, right? Every time we get to that level, we got back with that Black Monday exception I mentioned earlier. So it's a major bullish target, right? But we need to take first 12.15. And I would say that a weekly close above 13 would open doors for that 160 pips gain. But it's still far away from me right now.
Okay, thank you, Valeria. So time for Yohay. Yohay, what is your expectation for tomorrow, and what happened today, and what will happen with the dollar in the next few days?
Well, so again from today, I think that the downgrade of the dot plot was quite expected, but we had a few other dovish things there. I will note 4 things. First of all, the mention of weaker global growth, despite stability recently in markets. Second thing is that they lowered the inflation forecast this year. This is contrary to the rise in inflation that we've seen today. So it's rise in inflation in the general CPI, but they look at the core PCE. Another thing is that they use the word soft in describing exports and business investment. And the fourth thing that shows how dovish it is the fact that one member dissented to the hawkish side, Esther George. So all these things together culminate in a dovish statement. Again, maybe another fifth thing was that markets did expect some kind of to remind everybody, also I expected that, to remind everybody that the Fed is still on the path to raise rates. In theory, they are, but you know, each time they downgrade their forecast. So yeah, and as Valeria said, in the Tokyo Open, we'll have another reaction. We'll have analysts talking about the Fed decision. We'll also have the European Open reaction. All in all, it's dovish. That's very easy to see and to say. I don't know if we'll have an extension of that. Everybody's dovish, so it's not that. I think eventually the Fed is still the cleanest shirt in the dirty pile. Tomorrow morning we have the Swiss National Bank. No changes expected. With the current levels of euro-dollar, I don't see them needing to lower further rates, despite the fact that they're ECB and they're sort of in rivalry with the ECB. I don't expect them to cut rates or to announce new measures at all, but they will, of course, stay vigilant and say that they'll continue intervening. And the Bank of England, Mark Carney is getting a very high salary for not doing any policy changes, and I think this will continue, as Valeria said, into, well, further on this year. Of course, now the uncertainty about
Hi. Okay, sorry, we're alive. Sorry, guys. Mauricio fell,
You're in.
Yohay fell, the connection fell. It's not the best day today, Yohay.
I'm back, yeah.
Yeah, me too. Okay, well, anyway, guys, thanks all for being here. Thank you, Yohay. I don't know if you were wanted to add something else, but well, this time was Mauricio, the one that left us, so here he is. Okay, anyway, we are saying bye and thank you for bearing with us today. It has been a tough day. See you back tomorrow, okay? And hopefully internet will work better for us and computers and everything else. Anyway, the market is always fun and it's always great to be with you guys. Thank you, Yohay, and bye. And thank you, Mauricio. Bye-bye.
Thank you, Valeria, and thank you, Yohay. See you tomorrow in the BOE live coverage. And sorry for the latest interruption.
Yeah.
It's our connection. But thank you, and see you tomorrow. Bye-bye.
Yeah.
Bye-bye.
Bye-bye.
Bye-bye. Bye-bye. Peace.